Are you a UK business owner and do you ever get that nagging feeling you might be paying way too much tax? Well, you're not alone. It is one of the biggest questions out there. And today we're going to tackle it head on. Should you be a sole trader or should you be a limited company? To help us through this, we're using a fantastic brief put together by the experts over at Pro Tax Accountant. Okay, let's get into it. So picture this. You've had an amazing year. Maybe you're a freelance web developer based in London, and you finally landed those huge clients you've been chasing. The money's coming in, things are looking great, and then a brown envelope from HMRC drops through your letterbox. You open it, and that tax bill is just, wow, it's so much higher than you planned for. And that's the moment you start asking yourself, is being a sole trader actually holding me back?
To figure that out, let's first break down the structure that most people start with, the sole trader. Look, it's the simplest and quickest way to get your business off the ground, no doubt about it. But that simplicity can come with a few, shall we say, costly surprises later on.
Now, this is absolutely the most important thing you need to grasp about being a sole trader. From a legal standpoint, you and your business are exactly the same thing. There's no separation. Every single pound of profit the business makes is treated as your personal income. But here's the real kicker. You are personally on the hook for any and all business debts. That means your personal savings, your car, even your home could be at risk. It's a huge thing to think about. So let's look at how the tax actually breaks down for the 2025/26 tax year. As a sole trader, you kind of get hit with a double whammy. That's income tax and national insurance. The first $12,570 you earn is tax-free, which is great. That's your personal allowance. But after that, you're paying 20% tax plus 6% Class 4 national insurance. And once your profits climb over that $50,270 mark, that tax rate jumps to a massive 40%. When you add it all up, you can really see why those tax bills can feel so painful. But here's the thing. That is not the only way. As your business starts to grow and become more successful, a whole other path opens up, one that totally changes how you're taxed. And I'm talking about forming a limited company. Honestly, not thinking about this switch at the right time is one of the biggest and most expensive mistakes a growing business can make. And this slide really lays out the core difference. A limited company is its own separate legal person. It's totally distinct from you. So the company itself pays corporation tax on its profits, and you only pay personal tax on the money you choose to take out. This separation is the absolute key to not only saving tax, but also getting that crucial protection for your personal assets. Okay, I can hear you asking, if the company is this separate thing paying its own tax, how on earth do I actually get my money? And that is a great question. This is where things get really clever, and it's all about using a smart mix of a small salary and something called dividends. Right, let's walk through it. First, your company makes a profit. Simple enough. Then it pays corporation tax on that profit. For the 2025/26 tax year, that's 19% on profits up to £50,000. Now, from the money that's left over, you pay yourself. And the most tax-efficient way to do that is to take a small salary and then take the rest as dividends. Why? Well, because dividends aren't subject to national insurance. And that right there can save you a serious chunk of cash. And here is a fantastic pro tip for you. The absolute sweet spot for a director's salary is often £12,570, exactly the same as your tax-free personal allowance. Pay yourself this amount and you won't pay a single penny in income tax or national insurance on it. But here's the really clever bit. It's still high enough to count as a qualifying year for your state pension. So you're basically building up your future pension credits for free. It's a win-win. So this all leads us to the million-dollar question, or maybe the £50,000 question. At what point does it actually become more profitable to make the switch from sole trader to a limited company? Now, stay with me because the answer on the next slide might just surprise you. And there it is. Now, of course, every business is different, but as a general rule of thumb, once your annual profits start hitting that £40,000 to £50,000 mark, the tax savings from a limited company structure really start to show. This is what we call the tipping point, the moment you need to be seriously thinking about making a change. Okay, let's just look at the hard numbers because they really do tell the story. At $20,000 and even £40,000 of profit, you can see the sole trader actually takes home about £800 more. The simplicity wins. But look what happens when we hit £60,000 in profit. Suddenly, the tables have completely flipped. The limited company director now takes home £720 more. Why? It's because at this level, the sole trader is getting hammered by that 40% income tax rate, while the limited company's combination of lower corporation tax and dividend tax becomes way more efficient. Now, it would be really easy to just stop right here and say it's all about how much money ends up in your pocket. But honestly, that would be a huge mistake. The decision to go limited goes so much further than just your tax bill. In fact, for a lot of you, the stuff on this next slide will be even more important.
Let's just quickly run through these because they are genuine game changers. Limited liability, that's the big one. Think of it as a legal firewall between your business finances and your personal finances. If the business fails, your home is safe. Then there's credibility. Having LTD after your name just looks more professional to bigger clients and banks. Your business name is legally protected, and you can claim for a wider range of expenses, like putting money directly from the company into your pension pot, which is another amazing tax-saving trick.
All right, so we've covered how both setups are taxed, we found that crucial tipping point, and we've looked at all those other massive benefits beyond just tax. The only piece of the puzzle left is, what should you do now?
So what is the right choice for your business? Because that's what it comes down to. There really is no one-size-fits-all answer here. It all depends on your unique situation. What are your profits right now? Where do you realistically see them going in the next few years? And how much personal risk are you actually comfortable with? These are the questions you really need to be asking yourself. Now, this is a really important point. This guide has been designed to give you a really clear overview of the options, but it is absolutely not a substitute for professional, tailored advice. Your business is unique, and you really shouldn't be making a big decision like this based only on what we've talked about here today. Before you make any moves, it is essential that you speak to an expert who can sit down and look at your specific numbers, your industry, and your goals. The team at ProTax Accountant, who put this whole brief together, are the perfect people to help you do just that. Their contact details are on the screen for you now. So the real question is, could you be leaving thousands of pounds on the table by sticking with the wrong structure? Make the right choice for your business's future. Get in touch with them. Thanks for watching.